Hi guys, today we are going to continue our discussion on the normal distribution and how to calculate the probabilities for different price ranges when the time frame is not 1 year. Let's get right into it. The expected move. This is how much a stock is expected to move in the future, and it is based on one standard deviation. To calculate the expected move, you need three information: the current stock price, the implied volatility, and the number of days you are looking at. Here is the formula to calculate the expected move for stock. The current stock price multiplied by implied volatility, which is a percentage, multiply it by the square root of the number of days divided by 365. Let's go through an example on how you can calculate this. Here we have a screenshot on Disney, and we are interested in options that expire on 16th of July, and we want to find the expected move for Disney. The current stock price for Disney is $172.40. The implied volatility for the 16th July option is 27.7%, and there are 54 days to expiration. To calculate the expected move, we take the current stock price of $172.40, multiply it by the implied volatility of 27.7%, and multiply that by the square root of the number of days to expiration, which is 54 divided by 365. From this we get 18.36. This means a one standard deviation move is $18.36. Remember that implied volatility can only suggest the size of the move, but not the direction. So to find the price range, you will have to add and subtract one standard deviation from the current price. For the options expiring on 16 July, the current implied volatility is suggesting that there is a 68% probability Disney will be between $154 to $190, 54 days from now. With this information, you can gauge if the option you're interested to buy has a high probability or low probability of success. For example, back to the options for Disney. If you choose to buy the 195 call, Disney needs to move more than one standard deviation in order for the 195 call to be in the money. But if you choose to buy the 185 call, Disney does not need to move as much. Of course, for higher probabilities, you have to pay more. Similar to what we covered in earlier lessons, options with a higher probability of being in the money will cost more. Looking at the option chain, you can see that the 195 call costs around 95 cents and the 185 call costs around $2.20. And this is consistent with what we learned in earlier lessons. So the expected move is a method you can use to calculate the probabilities, regardless of the time frame you are interested in. Now I want to talk a bit more about the normal distribution. In the last lesson, we covered that the center of the normal distribution is the current stock price. The area under the normal distribution, the area under this blue line, represents all the possible outcomes of the normal distribution. Or in this case, all the possible prices a stock might be 1 year from now. A one standard deviation move will capture at least 68% of all possible outcome. This means there is a 68% probability the stock will be in this price range 1 year from now. One way to actually help you visualize this better is to actually flip the normal distribution onto its side. Here I have the chart for Apple. In the chart, the current price for Apple is about $124. When you flip the normal distribution and align the center of the normal distribution to the current price of $124, the probabilities might start to make more sense. Let's say a one standard deviation move for Apple is $20. One standard deviation above is 144, and one standard deviation below is 104. And there's a 68% chance that Apple is going to be in this price range. Now, let's say you choose to buy a call. and you decide to buy a call one standard deviation above at $144. You make a profit if Apple closes anywhere above $144. So you want Apple to move above $144. The entire area under the normal distribution represents 100% all possible outcomes for Apple. As the normal distribution is symmetric, the area is the same on both sides. Half of this is 50%. Plus minus one standard deviation is 68%, so half of it is 34%. This means for your 144 call, based on the current IV, there is an 84% probability that Apple will be below $144, and only a 16% probability that your 144 call will be in the money. The percentages don't favor you if you were to buy this call. But keep in mind, because of the low probability, the premium to buy this call will also be quite low. I hope this has been helpful for some of you to better visualize the normal distribution and how the probabilities are linked to the current stock price. Buying a call one standard deviation away only gives you a 16% probability that the option will be in the money. In this case, it almost seems better to be selling the option instead. Because if you sell this call option, as long as Disney is below $144 at expiration, the option will expire worthless and you can collect the entire premium on the option. So Disney can drop to $100, it can remain at $124, it can even go up to $140. As long as it is below $144 at expiration, that option will be worthless and as a seller, you make money. In my very first lesson when I talk about options, I focus more on the buying portion. I didn't talk about selling because I mentioned that as a seller, there are more possible outcomes compared to buying options. So it's slightly more complicated and I did not want to go into it at the start. But in the next lesson, we are going to revisit buying options and we are going to look at selling options. How selling options can benefit you and why more often than not, people choose to sell rather than buy options. Now, for the last part of this video, I'm going to show you proof of how the day-to-day stock price movement follows a normal distribution. What I have here is an Excel file with the prices for the Dow Jones Index. The Dow Jones is a stock market index that tracks a lot of US blue chip companies. I'm going to use a Dow in this example. You can skip forward if you don't want to see the steps on how to create the normal distribution. You can skip ahead to the graph and explanation portion. But here are the stats for those who are interested. So what we have here is the opening, highest, lowest, and closing prices for the Dow on a daily basis. We have 1 year's worth of data from 16 April 2020 to 16 April 2021. I'm just using 1 year as an example. If you want to get more data and run this example, it is also fine. You can compare the numbers I have here versus the Dow. So these are all actual numbers from the Dow. So what we want to see is the percentage change in the closing prices on a daily basis. To get this, you take the closing price of whatever day you're looking at, minus the previous day's closing price, divided by the previous day's closing price. So what you're getting is essentially the day-to-day percentage change. So the Dow on 16 April 2021 closed 0.48% higher compared to 15 April's closing price. Now apply this formula on all the records. Delete the last row because there's no 15 April 2020. What I'm going to create now is actually a histogram to show the normal distribution for the Dow Jones. To create a histogram, you need bins. I'm going to create bins from negative 8% onwards, and each bin will increase by 0.5%. Now, what is going to happen is, if there's a day where the Dow drops by more than 8%, it will fall into this bin. If there's a day where the drop is between negative 7.5% to negative 8%, it will fall into the negative 7.5% bin, so on and so forth. Now I'm going to create the histogram. So this is actually an add-on that every Excel program has. You just have to turn it on. I'm not going to get into the steps for this, but you can Google to find out how to get the data analysis tab if you're interested. So when I run the histogram, here is what I get. It is showing us the distribution of the day-to-day percentage change of the Dow. And you can see that this distribution is very similar to a normal distribution. The majority of the data lies near the center. The most common daily change is between 0 to 0.5%, and the next most common is between negative 0.5 to 0%. From this distribution, we can also say that the standard deviation should be relatively low, as most of the data is located near the center. I only use 1 year's worth of data to create this histogram. You will find that if you use more data, 2, 3, or even 5 years worth, the more data points you have, the closer your final distribution will look like a normal distribution. You can check this out on your own. And with this, I'm going to conclude this lesson. So for the next lesson, we are going to revisit buying options and going in depth on selling options. We will also cover some of the common option strategies like cash secured puts, covered calls. We will also go into vertical spreads if there is time. Thank you for watching this video. As always, feel free to leave a comment if you have any questions, and I will do my best to reply. If you found this video useful, it would be awesome if you could like the video and share it. If you have the means and you would like to support the channel, I have a link to my PayPal below. Any donations will be very much appreciated. Thank you.